So next up we have Stephanie joining us, Stephanie Pomboy. She's the mastermind behind Macro Maven's institutional research service. For those in the professional investing world, she came from the ISI, C.J. Lawrence, I don't know, they call it a diaspora in the research world, I don't know. But she's coming to us here from New York, and let's give her a round of applause. Stephanie.
Okay. Is it possible?
Oh, also, you have her slides in your folder if you want to follow along on paper.
Can I just put this up here?
You can. Yeah.
Okay. You know, I'm a dumb blonde. I can't multitask like this, so. And the clicker thing is.
There you go, just forward.
Okay.
Yeah. And
Thank you.
laser pointer.
Cool. Great. Thank you. Hopefully I can figure this out. Anyway, thank you very much. Can you hear me okay? Perfect. Thank you. Anyway, thank you very much, JJ, for the introduction. You know, I had planned originally to give this presentation in the form of a somewhat less hirsute Ben Bernanke, and I even brought like a little prop to help you envision me as Ben Bernanke. But if it's okay, I'm just going to play Stephanie Pomboy here and walk you through these images. But the inspiration was basically trying to back into why it is that Ben Bernanke decided to pass up an opportunity at a second term at the Fed. And I think some of the images here will probably offer some insight into that, or at least they do from my perspective. So hopefully I can master the clicker, but I may just refer to the paper handout that you have here. Oh, look at that. Okay, so, you know, I guess basically I imagine that for Ben Bernanke, this all started pretty innocently. You know, faced with the fallout of a bubble that was largely the Fed's making in the first place, he basically decided, well, we'll try this exercise again, only this time, rather than waiting till things get completely out of control, we'll rein it in, you know, beforehand. We won't wait for people to cash out an entire year's salary in one phone call to their mortgage broker. We'll figure out the moment that the handoff between asset inflation and income growth has been accomplished, and that's when we'll rein things in. And so in 2009, obviously after slashing rates, they embarked on QE, and it took a little while, but begrudgingly the credit wheels started to turn. Stock prices turned up, the real estate market recovered, and after 5 years, household net worth is up over $20 trillion. So for Bernanke, this was a stunning success. Asset reflation had definitely been achieved. The small problem was that consumer spending, e.g. 70% of the US economy, continued to languish. 5 years on, we have never seen a gap, as you can see on this chart, between household net worth and consumer spending anywhere close to this magnitude. So despite the $20 trillion increase in household net worth, plus the $1 trillion a year that companies are shoveling at high-end households in the form of dividends and share buybacks, the wealth effect has just refused to set up. If you'll flip to the next page, I think for Bernanke, this was probably, you know, as a student of Japan, just a testament to the forces of deflation that he was up against. And so I would imagine that it was his feeling, you know, I know full well the dangers of exiting too early, having studied Japan's mistakes, so I'll just keep plowing ahead and continue priming the pump. But by spring 2013, signs of froth were all over the place. As you can see on the table on the top there, many metrics showed risk appetite at the highest levels since the eve of the financial crisis in 2007, even though the fundamentals were nowhere close to as strong. So for Bernanke, this was setting up a recipe for a potential financial market correction if things got too far ahead of the fundamentals, and that would stymie his hoped-for wealth effect. So this is why I envision in May of 2013, he dropped the T-bomb in his speech to try to cool things off a little bit, not because he was concerned about, they need to rein in QE, but because he knew they had to continue QE much longer to get this wealth effect to set up. And he just needed to cool things off for a little while so he could continue on their reflationary course. And for a little while, it worked. Financial conditions tightened, but before you knew it, obviously, everything was off to the races again. And as mentioned earlier, the credit markets were going berserk. Junk yields and spreads notched record lows. PIK issuance returned, levered loans, Cov Lights. All of the mistakes of the prior cycle were being made in spades. At the same time, the market cap of equities to GDP, the broadest measure here, was notching extremes not seen since the all-time peak in 2000. So for Ben, this was starting to get a little dicey. Maybe this exercise of rescuing the economy from one bubble by inflating another wasn't going to be as seamless as he imagined it would be. The worst thing, if you'll flip to the next page, is that while the tightening of financial conditions from the taper talk didn't stick, the hit to the economy did. And nowhere more so than housing, which has been so critical in the modest recovery that we had. And it did so really at the worst possible time because the institutions that had been so critical to turning around the housing market, you can see them kind of imputed in the empty space between mortgage applications and home sales. Obviously, institutions don't file mortgage applications to purchase homes. So the gap between what happened with mortgage apps, which basically went nowhere, and sales, which went berserk, kind of implies the role that institutions were playing in this market. They were already heading to the exit before he dropped this T-bomb. And then the handoff that these institutions were hoping to make to actual home buyers was being foiled now by the fact that mortgage rates sustained the increase. So this was really kind of stifling the reflationary impact from the real estate inflation. And again, this lasted a lot longer than Bernanke probably ever imagined it would. In fact, sales continued to decline months and months after that taper talk diminished. And if volume precedes price, as you can see in the bottom chart, Bernanke had to know that there was a real potential for outright price declines in the months to come. Again, this would sort of stymie his hoped-for wealth effect. Of course, there was always the chance that financial assets would just continue to go bananas. And that was a pretty good prospect, and that would at least help to offset this drag from slower real estate inflation. It wouldn't be the ideal scenario, obviously, because a lot more people own homes than own equities, but at least if we could keep the high end humming, eventually, you'd have that trickle down, and maybe there was some chance that its wealth effect might still set up. The little wrinkle was that the key distraction, or let's say the key rationale for investors to continue plowing into stocks, despite clearly lackluster economic fundamentals, which was corporate profit growth, was itself in jeopardy. As you can see in these charts, the boom that we saw in corporate profits was due largely to three factors. First and foremost, the reduction in labor costs, which they did right out of the gates in the 2009, Great Recession lows. They slashed labor costs to the lowest share of total top line in history. After that saving was wrung, they also wrung the cash register in terms of reduced interest expense, courtesy of the Fed's QE. But as you can see on the top chart, that was exhausted actually a couple of years ago. And finally, financial institutions saw a huge boon to profits by releasing reserves for losses, which apparently were no longer going to materialize. So combined, these three factors were really the drivers of the boom in profits. And that reality was about to be revealed since they were all now exhausted. What people would discover is the next chart, and that is that profits had been entirely due to these one-time factors, and had had nothing to do with the economy. And in my view, there's no more succinct illustration of that than this chart. This is nominal consumer spending, which should be probably the best economic proxy for top-line revenues for corporations. It's obviously, total consumer spending, 70% of the economy. And as you can see, like the wealth effect chart on the first page, we've never seen a gap of this magnitude before. Obviously, the hope or expectation is that top-line growth will pick up here, immaculately, I suppose. But nothing that I look at, as you might infer from my presentation so far, suggests that that's going to happen. And so I'll get into, this is where, sadly, my presentation is very short on regression analyses and algebra, but this is about the most math that I've got on page 7 here. And this is sort of a little bit arcane, but if you drill down and try to separate out demand from total spending, we look at nominal consumer spending was that prior chart, which is the sum of units and price, which is obviously what you want to look at when you're trying to figure out what's going to happen with corporate profits. But when you're trying to figure out what's happening with consumers, it's kind of interesting to parse out demand from price. Are they spending more because they want to spend more, or are they spending more because the price of the stuff they usually buy has gone up? And it turns out that the latter is the explanation right now, and it's especially true when you look at the discretionary purchases, which is what the chart reflects. It's retail sales, which is really the most discretionary form of consumer spending, and I've taken out food and energy just to really get into the most discretionary component. And as you can see, basically the entire recovery that we've seen since the crisis has been a result of inflation. It has not reflected an improvement in consumer demand whatsoever. And when I look at this, my conclusion is that households are just struggling to maintain a lifestyle that debt enabled them to afford before. And what they're doing is they're undertaking whatever measures they need to cling desperately to this lifestyle that really they can no longer afford. They've been dissaving, some have strategically defaulted, they're taking out student loans, they're going back to school, et cetera, et cetera. But again, my interpretation of what's happening on the consumer spending front is very different, I think, from the consensus, because I'm parsing out the demand picture from the price side. Would also highlight, boy, we just get deeper and deeper in the cave here. I should have forewarned you about that at the beginning. But the odds that we have this immaculate recovery are diminished, in my view, by all the same factors that are now threatening corporate profits, and that is that the benefit of reduced interest expense that accrued to households throughout this cycle is also now over. In fact, the bottom chart shows that interest expense is actually starting to move higher for households. They saved $150 billion during the QE stretch in terms of reduced interest expense, which is pretty significant. They also, and perhaps surprisingly to a lot of people, they had a cash out refi boon. It wasn't anything compared to what we saw during the housing bubble heyday, but households were able to cash out $350 billion in this QE stretch. When you compare that to the prior chart of consumer discretionary spending that has grown $450 billion, you can see this cash out thing is not an insignificant impact. So again, with the backup in mortgage rates and the cooling of real estate inflation, these two benefits also appear to be behind us. And so that brings us back to the question of, what is going to drive or support corporate profits and particularly stock prices from here. And I guess from Ben Bernanke's standpoint, there was really only one answer, and that is continued liquidity. The only thing that can fight the force of gravity here, if profits start to revert to the mean, is continued Fed money printing. The problem is, And this is really why I think Ben Bernanke left. I suspect, I've never met the man, but I suspect, given the history of central bankers in this country, that it wasn't for lack of hubris. I'm sure that he imagined if he inflated another bubble, he'd be able to manage his way around that. There was a much bigger problem for him, and that was that every day they continued QE, they chased away more and more of our foreign creditors. And the dollar diversification had begun several years before QE, but obviously accelerated dramatically during the last 3 years. In fact, if you flip to the next page, you can see that in the 3-year QE period, foreign purchase of treasuries withered from $800 billion to just $100 billion today. For some reason, this doesn't seem to get a lot of attention, and I told you I'd spare you some math, but here's the math. The deficit has shrunk from $1 trillion to $500 billion, but compared to the $100 billion in foreign purchases, by my calculations, that leaves $400 billion in slack, which to now the Fed has picked up. The question is, if they continue to pick up this slack, they're just chasing more people out of dollars. And they're doing so at a very dangerous time because now China has replaced the U.S. as the world's largest oil importer, which is begging the question of why continue to trade major commodities in dollars when the largest purchaser is not a dollar purchaser. And China obviously is aggressively cobbling together trade agreements in its own currency. And has been so successful in that regard that it's catapulted the renminbi from obscurity to the 6th most traded currency in the world in no time whatsoever. So it's a very dangerous moment to be pushing the pedal on QE and incentivizing our foreign creditors to look for alternatives. The problem is that we're now kind of at the point of no return because at 2% nominal and 0% real on a treasury, there is no natural buyer anymore. So what started out as a discretionary economic policy, QE, has now become a deficit financing necessity for the U.S. The options right now are either to continue to taper and risk having higher rates destroy the economy, or continue QE and risk destroying dollar hegemony. And I think those bleak options are why Ben Bernanke decided to pass the baton to Janet Yellen. Good luck to you, chick. And that's the end. So I guess we can move on to questions.
We'll start with audience questions, and maybe Mike, if you want to, did you have questions you want to go up and facilitate or no? Okay, we'll just do it from here, and I'll try to repeat the questions, or you can, Stephanie, so we can catch it on the mic.
Okay.
And actually, while we're here,
Okay,
a little bit closer would be better.
Sorry.
Actually, I'll start the questions because I have one, and that is, I recall you relating a story about someone at the Fed in this chart. Do you think they're aware of what's going on from foreign purchasers and whether their role has to be, aligned with them? In other words, filling those gaps, or do you think it's something that's not really on their radar?
I mean, I can't imagine it's not on their radar, but I guess we had talked about this. I was shocked. The last time I spoke at a conference, there turned out to be a staffer from the Federal Reserve in the audience, and I went through this math, and at the time the math was equally challenging. I thought this is basic stuff. It's every month they release the TIC report. I'm not like a rocket scientist here. I'm just looking at the numbers as they hit the tape. And so I went through this, and at the break, this staffer came up to me and she said, I just want to go over this chart with you. Are you saying that if the Fed doesn't buy this paper, there's not enough foreign purchases to absorb deficit issuance. And I looked at her and I thought, well, maybe she's being facetious or something. Like, is she pulling my leg? And I thought, I would think this chart is kind of posted on the wall in the men's bathroom at the Federal Reserve. I mean, it was mind-boggling to me. So I kind of looked at her puzzled, and she said, "No, Rick, can you walk through the math with me?" I'm like, this is second grade math. This isn't complicated. There are no regressions here, right? Okay, this is straightforward. So that was a real wake-up call to me that maybe they weren't focused on this. That was 6 months ago or so. And in the time since, you had that Russian fire drill, where suddenly everyone noticed that a whole bunch of treasuries had exited the Fed in the span of a week. So I have to imagine they're a little more focused on it now. And, I guess my whole presentation was a little tongue-in-cheek. But for Ben Bernanke, the dollar interplay here had to be, something he was very aware of. So I also think that they seized on this window of opportunity with the narrowing in the deficits to do the taper, because there was actually a fair amount written about how big a footprint the Fed was having with the size of its purchases, particularly at the long end, given the reduction in issuance. But that was a sort of temporary window, and it's going to open back up in the years ahead. Sure.
There's one more graph in our.
Oh, yeah.
Would you care to comment on that?
Well, it's sort of where this ultimately takes me is that my hunch is that given the two choices I laid out, which is to continue QE or to taper and risk, destroying the economy, history suggests the Fed will opt for continuing QE. And so I do expect them at some point to hit the pause on taper, and at some point maybe even re-up or implement a different policy designed to accomplish essentially the same thing, in which case this relationship between gold and the Fed balance sheet will be restored. I'm kind of struck that from the day they launched QE3, gold traded inversely to the Fed balance sheet. And to me, it was a signal that basically everyone saw QE3 as the end. It's like they're done. They're doing their final little tweaks. So why should we sit around here and wait for them to finish rolling up this policy? We'll just start, packing our bags and positioning for the next, macro trade. And my sense is that, everyone had that attitude wildly prematurely, but time will tell. Yes.
Recent reports, about the fine and treasuries that process.
Right.
And it's interesting because the math I've done, it matches pretty much perfectly with what we take. So, have you looked at it at all?
Well, sorry. The question was, there's been a sizable increase, especially in the latest month, of purchases of treasuries by Belgium, which, is mysterious. And the question was, it matches exactly the amount that the Fed has tapered, the implication being, I suppose, that maybe the Fed, through some entity, was purchasing offshore. This is the problem with the data, is that, it doesn't really tell you who's buying. It just tells you the location of where the trade was executed. So it certainly is prone to conspiracy theories. And I'm certainly a fan of plenty of conspiracy theories. But, I guess in my view, I'd be more inclined to believe it might be the ECB than the Fed. But frankly,
could be behind this. Is that possible?
I guess it's,
Because we fund it.
Right.
You're watching it, obviously.
Yeah, I mean, I'm watching the numbers in aggregate, and certainly I look at the the country breakdown as well. But it's a mystery that we'll never know the answer to, so we can speculate about. But ultimately, I think that the numbers are just too big for the Fed to monkey around with in this manner. That's my sense, but who knows? Maybe next month, Luxembourg will be a big purchaser. Are there any other questions?
Right.
All right.
Thank you very much, Stephanie.
Thank you.